I'm turning 53 this year and I've been investing for over 30 years. This little trick has made me a lot of money. I've adapted it from listening to other successful investors and now I'm going to teach you. Bought some stock today at 20% discount to the all-time high. S&P 500 all-time high was 61.44. This is a staggered down approach that I've used for the last 30 years and I got up before 11 a.m. on April 9th, 2025. That's over here in the red square. Hopefully it's not the bottom because again, lower prices are better prices. He doesn't outright go into what he does, but he does say he always has cash to invest. He never ever runs out of cash. Called it the elephant gun or having 30 billion in reserve. Quote, Buffett explains that he always keeps at least 80% of his net worth invested in stocks and prefers that number to be closer to 100%. Berkshire's current 80 or so position in business is a consequence of my failure to find entire companies or stocks which meet our criteria for long-term holding. And here it is in Warren Buffett's own words.
I have never had less than 80% of my money in American business. You can call them stocks.
Or equities.
But I see them as American business. I've owned a piece of American business for at least 80% at all times. And, I don't want to own anything else.
35 years ago, when I was a teenager, I heard the same problem from adults who said, I wish I could buy this dip, I don't have the cash. I thought about this problem and I realized that it had a simple solution. I call it the opportunity bucket or staggered down approach, but this is what it does. Whatever your asset allocation is, say 80% equities, 20% non-equity, whatever that non-equity portion is, when the stock market goes down, personally, my temperament is I become more interested in buying more stock. This method only works when you get excited by lower prices. If you get excited by higher prices, it won't work very well for you. So let's put some numbers to this. Let's say a $100,000 portfolio, 80% equity, $20,000 non-equity. The market could go down. We know that from history. It can go down by 20, 50, 80%. That's an opportunity. We know that time in the market beats timing the market, but you're already in the market because you're keeping an asset allocation of 80-20. It's no problem. You can keep on going and everything will be fine. If your temperament is like mine and you're thinking, well, this is an opportunity that doesn't come along very often, how can I take advantage of it? I take the 20% non-equity and I can split it into 4 or 5 parts. $20,000 split into 5 parts is $4,000. $20,000 split into 4 parts is $5,000. When the market goes down by 20%, I lump in the first batch. Everything else really stays the same. Market goes down by 40%, I lump in the second batch. And so on and so forth. You can see that unless the market goes down 100%, I will always have cash on hand. Now, my asset allocation will obviously change. When you start at 80-20 and you start chewing into the non-equity portion, your equity percentage is going to go up. And I don't mind that happening when the stock market is falling because lower prices are better prices. I have time in the market, I take advantage of downturns that don't come along very often, and the opportunity bucket will never go empty. Learn the lessons about money that your friends and family just don't know. Download my free newsletter linked off the bio. Good luck. Take care.